Hello and welcome to another Twitter space organized by MarginX. I'm Jenny, who's the host of this podcast, and I'm also a crypto influencer myself on both English and Cantonese content. Today's topic is all about DeFi because this society we're living in right now, we need DeFi to give power back to people, but there are so many DeFi projects out there. We'll be discussing which one has better APR for all of your farmers out there. And there's also some secret formula, I believe, to help reduce your impermanent loss. So joining us today are some of the great builders in the field. In a way, I would say I kind of appreciate this bear market because it separates those who are genuinely contributing to the space from those who are just in it for the quick buck. Well, allow me to bring in my first guest today. His name is Clement, and he's the regional manager of CoinStore Exchange. So, Clement, would you please tell us, our listeners, who you are, what do you do for the company, and how long have you been in crypto?
Okay, thanks, Gary, for the introduction. So, to everyone listening, I'm Clement. So, I'm the regional manager for CoinStore Exchange. We are a centralized exchange that's based in Singapore, and our markets are mostly in Southeast Asia. So, I've been with the company almost since it just launched. So, that's almost about 2 years ago right now. And in terms of crypto wise, I think I've been around in the space as a retail investor since 2017. So I was part of some of the trends from DeFi summer to the metaverse, NFTs, and so on. So yeah, happy to be here today. I'm also representing Cloth as a co-founder and also chief operating officer. So happy to share more with the listeners today on DeFi and what risks and riches are associated with it.
Well, it's great to have you, Clement. Well, moving on to our next guest, we also have Amadeo, who is the co-founder of YieldNest. So, Amadeo, please take it away. Tell our listeners what you do, how long have you been in crypto, etc.
Hello there, guys and girls. I've been in crypto for a long time. Since 2012, I got to know it first and then dabbled around a bit. You know, my background is software engineering, so very quickly I heard about it, learned about it, and in 2015 I joined crypto full-time, working for the first crypto hedge fund in the Netherlands. Then did a lot of other projects, mostly on the fund side and advising family offices and funds. And I very early on got into DeFi and advised a lot of companies and DAOs, you know, worked with MakerDAO, worked with Curve Finance, so working with Curve now and then for the risk committee. After that, now in the latest bear was like, no, let's go after my own project because I see DeFi as something very important for the space, and I felt that many people were not innovating enough in the space. So I was like, I was gonna try to do it myself. That's what YieldNest became. YieldNest was like a yield aggregator, yield optimizer. I saw some challenges with on-chain data availability and on-chain computation, and then stumbled upon EigenLayer. And then we recently made a pivot with YieldNest towards EigenLayer and restaking. So right now, YieldNest is doing restaking and building a liquid restaking token and building basically a balanced system between active validated services like restaking and node operators.
Well, it's great to have you too. I'm sure you have great perspective to offer to our listeners today. Well, last but not least, we also have Shin. Shin, welcome back. It's great to have you on again. Please tell our listeners who you are, give us a brief introduction, and how have you been?
Hey, Jamie. Yeah, it's good to be back. I've been good. I've been away for a couple of weeks, and since then, you know, Bitcoin has made a massive surge. So yeah, that's how fast things change in the Bitcoin world. So I'm happy to be back on this Twitter space with MarginX. Thanks for the introduction. My name is Shane, and I'm one of the core contributors to MarginX. So MarginX is DEX, and we have a lot of exciting offerings coming up in the next couple of weeks. Some of you might have already heard about the ELO algorithm that we have developed, and we are really, really active in DeFi space where not only are we implementing a limit order book style AMM style limit order book on our DEX, but also we are also taking in your idle LP tokens and allowing you to have a second life, so to speak. And that second life would be to use your idle LP token and play it on our DEX, MarginX. So I think it's a very exciting space. We are one of the many exciting projects that is happening right now in the DEX space. And I think, Jeremy, you made a very good remark. I totally agree with that. I think the recent bad run of the whole DeFi world is actually sort of cleansing the DeFi world of all the greed and all the bad actors. And I think what is really left right now are those players that are really serious about what they want to do, the people that really want to build a good infrastructure and really want to help the blockchain community and grow this. So yeah, once again, I'm happy to be here. Thanks for inviting me over, Jeremy.
Well, thanks for joining us again. It's going to be a great episode today. I have prepared so many questions to pick the mind of our speakers. So let's dive right in. So my first question, I would like to ask Clement first. Why didn't we go back to the basis? Like, I would like to ask you, what is DeFi to you? Just so our listeners are on the same page and understand all the basic knowledge of the crypto world, because it can be intimidating. And also, like, where do you see as an advantage of DeFi compared to traditional finance, you would say?
Right. So DeFi, as the short form suggests, decentralized finance. To me, what it means is to allow for transparency so that for users, when they see their transactions, they know what's going on. So a few of the advantages that there is from DeFi compared to traditional finance is that, for me, it cuts out the need for heavy transactional fees and middlemen. So, for example, in Singapore, if let's say you want to invest in the stock market, right, whenever you choose to make a purchase, sometimes you have to queue and wait for your order to be bought because there's no one taking the order. And then sometimes when you sell the stock, when you sell your holdings, you need to wait for T+3. But in DeFi, most of the times, all you need to do is to just pay for gas, and then the transaction goes through pretty quickly. So I think in terms of advantages, it's the speed of things and it's the transparency of things that the user can execute a transaction compared to TradFi. So for me, that's some of the advantages that I can think of.
Yeah, I'm completely with you. When it comes to DeFi, ease of mind is very important. Well, moving on to the next question, I would like to ask Shin, because right now we are in a high interest rate environment, which means you can earn a risk-free return by just parking your money at a bank. I believe right now you could generate 5% risk-free. So, like, why would I still be in DeFi then? And especially for like some cases like staking and farming, when I have to bear all those risks. Like, if a newcomer comes to you and asks this question, like, how would you answer that? Is it only for decentralization? What's your take on that?
Thanks for the question. I always like to begin my answer for such questions saying that this is not financial advice. This is like my personal opinion. There's no hard and fast rule. I can't say that it's a wrong decision for you to put your money in the bank right now where the interest rates are high. But here's my take, right? There's always a catch. The only reason, or the main reason that the bank interest rate is high is because the inflation rate is high, and it's part of the fiscal policy all across the world that they want to increase the interest rate. So if you think about it, right, you are getting 5-6% from the bank. That's because the inflation is also 5-6% or even more, right? So if you did a bit of a finance course back in the school days, you would know that when you want to calculate your net present value based on your depreciation of the value or whatsoever, you always take the interest rate, the bank interest rate, as a reference point, which basically means if your money increases as much as what the bank interest rates are, your money is worth actually the same. You're not getting more, right? So that's my first argument, that it's sort of like wrong to think that interest rates are high. Let's put the money in, but there's no harm in it, right? Like if you're really 9 to 5 worker and you got really nowhere else to spend, and you're a person with a very low risk appetite, that's fine. Then on the other hand, you think about DeFi, right? I think there's two good reasons why. Again, I can't say for other people, but for myself, that I would go into DeFi in a time like this. Actually, there's much more than two reasons, right? One of the key reasons is because DeFi is obviously a higher risk environment, but that also means that it's a higher return environment. As I mentioned before, that just in a couple of weeks that I was in hiatus, the Bitcoin has literally risen from the ashes from 24,000 to $34,000 this week, and it's probably not even the highest that many people expect. Many people expect by the end of the year it might be even higher. It might be right, it might be wrong, but over the long run, you can basically say that this 10-20% increase in Bitcoin is really something that's quite common, and that easily surpasses the interest rate that you're talking about, which is 5 or 6%. And ironically, if you follow the news quite closely, a lot of the funds actually circulates in the financial world. So when the stocks is not doing well, when the economy is not doing well, there are a lot of people in the TradeFi world they will park some money in the blockchain world. So when you see the stocks are not doing well, when you see that the economy is not doing well and interest rates are high, you can see that a lot of people actually move those funds over to the blockchain. And if you just ride the wave, then you would also profit from it, right? So these are already two very good reasons. I'll just chip in another third reason, which might sound a little bit funny, but I think it's a good reason as well. The third reason why you should do DeFi is because it's fun, right? You go into the DeFi world, there are lots of people doing a lot of fun things, interesting things, different kinds of ways you can use to invest your money, to play with investment, right? You can make money, invest while play games, right? Games, quote unquote, right? Having fun and things like that. So a case in point again, like MarginX, right? How we supercharge your IDA token, right? So, well, first of all, you have to know there's AMM, liquidity pool, and stuff like that. You generate LP token. Then here you have MarginX. We say that, your LP token, if you're not using it, you can pocket it with us, and then we'll generate tokens for you to trade on our DEX. So you can see that it's a very dynamic ecosystem where a lot of things happening. So if you pay attention to the DeFi space, it's a very interesting space. So for me, that's my personal third reason why I think DeFi is definitely the place to go compared to TradeFi.
Yeah, there are some really great points that you made. We are in a very high inflation rate environment. That's why the interest rate being so high. And also another good point that I tend to agree with you very much is always diversify your portfolio. So not only park your money into stocks or bonds, but maybe allocate a little bit of portion of your portfolio into crypto as well. Well, moving on to the next question, I would like to throw at Amadeo. So I wonder, speaking of DeFi, do you have a recent favorite for your DeFi project these days? Could you share a little bit to our audience today?
Yeah, thank you very much. And I agree with hooking back to the first questions first before answering the new question. Like I agree, but I think one point that's missing is that just we do it for freedom, and we're in decentralized finance because we want freedom, and we don't want we want a way to also say no to a current way of doing a monetary system, because we can only say yes if we also are able to say no to things, right? So I think freedom is also one of the biggest reasons that DeFi is a thing. And I think also DeFi is one of the biggest use cases of any blockchain system. Else it's just a inefficient database, in my opinion. The projects that I'm looking out for now is mostly Frax Finance. Frax Finance is a stablecoin, in my opinion, that is very much overlooked by many people. They are releasing a lot of very interesting new primitives right now. That's very interesting. I'm a big fan of Curve Finance, and of course, Eigenlayer I find very interesting as well, which I think the restaking primitive that Eigenlayer is going to bring is going to issue in a lot of new primitives on crypto. And I personally think that, yes, the fiat yields are currently higher, but you can see projects like Frax Finance that are bridging those yields, that in times when the interest, the US Treasury yields are higher than the money market yields, etc., that you can easily switch over with SFrax. And if you then can make more money in certain liquidity pools or restaking or base ETH yield, then they can easily switch over to that. And I think that restaking is going to offer a big new primitive that will, in my opinion, will generate a lot of more higher yields in crypto, and real yields, not just paper yields, but actual yields. Yeah.
Great, thank you. Well, I haven't checked out these projects myself, but after this podcast, you know what, maybe I would give it a go. Well, the next question I would like to ask Clement. Well, what are some of the social implications of the increasing adoption of DeFi you think there might be? Because if we want mass adoption to come, we should have like more use cases in real life. So in your case, like where do you think, like which area you think you could apply DeFi to?
Just to understand the question a little bit more, when you mention social implications, do you mean like if financial institutions could incorporate them, or do you mean mostly like for like the Gen Zs or like the millennials who could adopt DeFi?
I think maybe a little bit of both to call it adoption, right?
Right. So I guess for me, I kind of represent the DeFi degens. So I would think that first and foremost, it's important to be extremely safe, especially in the crypto market. So I still remember back in 2021 when DeFi was all about the talk of the town. I think everyone was trying to see who gives the highest yield, who has the most interesting protocols, who comes up with the most complex sort of DeFi. So I think if you're asking about the social impact that maybe adopting DeFi could bring, there's definitely it's definitely a double-edged sword, right? It could lead to more people losing more money over time if, let's say, they don't understand what some of the DeFi protocols are bringing about. Things like real yield is being constantly mentioned nowadays, and how some of these protocols are able to give investors some of these returns. But then again, it could also open a new era or new generation of people understanding more about crypto, understanding more about decentralization. And I think even the banks right now we see are trying to experiment on how they can incorporate some elements of DeFi into some of their products. So we shall see. I think maybe in the next couple of months when we see more newer protocols coming up and about, I think some of the newer ones that I'm currently watching are like Pendle. I see some of the more interesting ones like Y2K Finance, where they sort of help users earn some returns when there's a DPEG and so on. I think things like this can really basically give you a gauge of where things stand right now. So yeah, for me, there's definitely two sides of the coin, but I think if it's not controlled enough, it could lead to a lot of people not understanding what things are about and just going head into seeking out high APYs. And if let's say more institutions come about, adopt it more, I think maybe we could see a new era of more professionalism when it comes to DeFi.
Great, I love your answer. But to keep building on that, I would like to ask Shin, because a lot of people might not view DeFi being so safe. Like, I think one being that maybe DeFi insurance is not like a very commonly known thing. Like, could you explain a little bit to our viewer how DeFi insurance works, just so we're on the same page?
Yeah.
Shin?
Sorry, I got the mic on mute.
This space was downloaded via spacesdown.com. Visit to download your spaces today.
The DeFi insurance that I know of, it's not so much, at least to my knowledge, not so much on protecting your investment when you trade on DEXs. I think there are some out there that does that. But I think last year I gave a talk at the Singapore Society of Actuarials. It's about DeFi insurance in general. So how we can adopt some of these insurance policies, some of these insurance products onto the blockchain. So as an example, the one of the easiest and most straightforward examples is about travel insurance, where we try to insure people, if you're late, if there's a delay in your flight, more than say 1 or 2 hours, then you're entitled to be paid, with a certain amount of money, right? And the whole idea is that you have to go through all the insurance and all those claims process, which can be very tedious. And if you do it on chain, all these things gets automated, and you need to have an oracle that actually tracks the actual flight departure time, for example, against your policies, right? Then that oracle would be able to correctly identify that your flight's supposed to be at 12, but now it's already 2 p.m. It's 2 hours past that the original flight time, so you're entitled to the claims and will directly deposit the money onto your wallet. So the idea of having a DeFi insurance is as a product like that, where there's an insurance product that's built on chain, that your claims process is transparent, automated, and secure, right? So that's the idea. I'm not entirely sure but I got a feeling that you're asking more specifically to DeFi insurance that protects your trade money, right? Just in case something like FTX goes bust. Is that what you're asking?
Yeah, to protect the users of DeFi, basically.
Yeah, so I think there are some insurance out there that protect users of DeFi in a trade, but in my opinion, that is I might digress a bit, but I think that is the more important point. But I think the trust in the DeFi, I guess it helps, but I don't think that's the core reason for people not trusting DeFi products. That's number one, because I think you have to that for example, even no matter the amount of insurance that you're going to buy for trading in FTX, for example, when it goes bust, it goes bust, and more likely than not, when FTX goes bust, then your DeFi insurance might also go bust together with it, right? There is certainly a chance of that happening. I mean, we haven't seen that happening, but we know how DeFi works, right? There's lots of leverage, there's lots of linkages, and it's because it's a little bit unregulated. So these kind of things might happen. So in my opinion, DeFi insurance plays a role, but in building confidence of trading within the DeFi world, it starts from insurance, but it doesn't end there, right? There are a lot more things that we can do, and one of the most important thing to do is for developers like us and contributors like us to continue to build good products, to build that reputation, to build that trust. And also very importantly, no matter how well the reputation of a product, or I foresee in 3 or 5 years time when DeFi has truly matured, as the user, you should never stop doing your necessary due diligence, right? You should always do the due diligence, read through the terms and conditions, understand the risk that you have. Again, this is something that is a bit less common in the TradeFi world, because in the TradeFi world you have the government or the regulatory bodies to do that for you. But that defeats the point of us in DEX, as one of the speakers mentioned. The whole point of DEX is we want to be decentralized. We don't want a third-party person looking over all our transactions. Now, if you don't want a third party, you don't want a big brother looking over all your transactions, controlling what you can buy and you can't buy because you think it's unfair, well, then you yourself would have to do that, right? So we can't be lazy about it. We can't have the cake and eat it at the same time, right? You have to choose either one. But my point is that the confidence has to come from the developers themselves, and also from the users themselves doing due diligence. Insurance might play a role, but I think at this climate, my personal opinion, DeFi insurance protecting traders or DeFi users, the effect is going to be quite limited. But DeFi insurance as a product of putting all these insurance, travel insurance, maybe sports insurance on chain, that DeFi insurance as a product, I think that there's still a lot of opportunities to explore there. I hope I answered your question, Jamie.
Yeah, I think it's very interesting, the points that you made. For outsiders, they don't really trust DeFi because they just don't know how it works. And then there are so many scams from centralized exchanges like FTX. But at the same time, there's so many rug pulls, right? And that kind of kill off a lot of confidence. And for native DeFi users out there, there are actually a lot of projects not as decentralized as we thought. So that's why maybe DeFi users, maybe even crypto users, are not so confident right now. But would you think like I wonder what's your take on that? A lot of DeFi projects are so-called decentralized, but like at the end of the day, it feels like a company.
Yeah, absolutely. I agree with that. Like everyone that tries to say they are decentralized, right? But they're really not, right? Again, like MarginX, take MarginX as an example. We try to be as decentralized as possible. I've mentioned this a couple of times when I was presenting this in the Singapore FinTech Festival. We built the settlement engine, we built the Audible, we built everything on chain. We have a non-custodial wallet, so all of this is done on blockchain. And we don't, and not everyone does that, right? So a lot of people, what they do is you use a non-custodial wallet, but the rest of it is all centralized. They claim themselves to be a decentralized exchange. But to be fair, there's a reason why a lot of the products or a lot of the apps out there that chose a hybrid approach, because certain aspect of, for example, blockchain is very good at security and transparency, but blockchain is notoriously not famous for speed, right? We have some networks which are really fast, but generally speaking, blockchains are not the fastest technology out there. So that's the reason why they choose a hybrid version of it. And you're right, and because of that, there's a lot of exploitation going on where whenever there's a centralized bit of that version, there is a human element version, right? When you say centralized, means there's a human element interfering with if in part of that process, right, whether it's trading or whatever, right, the financial process, there's some human element in it. And whenever you have a human element in it, there's always a chance that the human might abuse the whole process, right? You have to trust that person. So, and I truly believe that, it's your whole system is only as strong as your weakest link, right? And so the whole reason we want to go DEX is that we don't trust human, right? We trust codes. We want it. We trust computer programming. We want it to be done that way, and it doesn't matter if the program might be not the perfect program, but but the program would do as what it's supposed to do. And as opposed to human, one day, it wakes up and he decides to do a rug pull. That's it, right? But now, unfortunately, I would say that none of our products out there can survive, even as of now, can survive with zero human intervention. We can minimize that to the smallest amount, but it cannot be zero. So to this point, like I showed an example. So I actually co-developed the LO algorithm on MarginX. So for those people who knows what that is, it's basically to automate the liquidity provision on the limit order book, right? And the whole reason why we actually adopt that approach and we actually took the inspiration from AMM is because I'm a firm believer of AMM, right? It's such an elegant model, such an elegant equation, XY equals to K. And then everything's automated, right? Like that's how liquidity is provided. It's complete transparency, complete consistency. This is how you're going to provide liquidity. And if you're going to take liquidity from the pool, you're going to exchange any token. This is how it's going to be calculated. No one can manipulate the process because it's exactly as the equation says. You might be arbitrage, maybe something is still possible that should happen, but that stems from your lack of understanding of the equation itself, not because someone out there is, because of their greed, they try to cheat your money or whatsoever, right? So sorry, Jamie, I took the wrong, not the wrong way, but the long way round of answering your question. But I guess the TLDR version is that you're right. A lot of the products out there takes a hybrid version, but to be fair, none of the products on the blockchain right now can survive with zero intervention of people. And whenever there's one people in charge and he becomes greedy one day, bad things would happen. So we have to minimize that. And I still firmly believe that the decentralized future that we have for DEX is still very bright. And there's a lot of space for technology to further improve on this one.
I love Vision. It's extremely insightful. Because for myself, I think DeFi, when it comes to DeFi, code is law. And I much rather trust code than some human, even though the code is written by a human. But you get the point, is to minimize the human touch. Well, moving on to the next question, I would like to ask Amadeo, because you mentioned the DeFi projects out there, and I wonder if you have come across any platforms that you offer really attractive APR that you feel like you just have to share to our listeners today.
Yeah, I mean, API is one thing, right? Like as I said, it's more about that you can transact freely, etc. I do want to one point for the earlier comment, right? I do think there is a lot of innovation and work to be done on AMMs. I think we're not there yet. There's going to be a lot of upcoming challenges with toxic order flow or the new RFQ model from Uniswap X that we need to resolve. So I do want to make people aware of that when providing liquidity or margin or doing option trading. There is a lot of unforeseen paths where basically like more sophisticated market makers or other parties are basically stealing funds from people that don't know that they think they're making a profit, but they're not, right? So when looking at APY or any of these numbers, they are mostly misleading. And yeah, I do agree that a lot of projects are not fully decentralized yet. I would even say that probably like 95% of all DeFi is not DeFi. So I think that term is just used too broadly. Most projects out there just work under a multi-sig or rely on oracles or other things. But luckily, we do have Oracle-free infrastructure. We have projects like Lido, or we have projects like Curve or Frax that are actually fully decentralized right now. One interesting yield opportunity that I would like to highlight is now everybody is trying to chase the free yield arbitrage between SDAI and other yields. That's why one of the reasons that we saw an uptake on DeFi activity is that a lot of people are arbitraging the yield gaps between Aave and Maker. So what a lot of people do nowadays, let's say you get a 5% yield on SDAI, and you can borrow a DAI or USDC for, let's say, for 2%. That means that you can basically make free money if those yields stay fixed, right? But of course, there's a lot of risks and involved in that. So I would not. It's kind of sophisticated. But what I would do right now, like if you go to Frax Finance, there's something called SDAI. SDAI is basically, S Frax, and that's stake Frax, and that kind of pays you a relatively safer yield on Frax. And right now, that's around 6%. But obviously, the more people that use it, the lower it will go. And you can even deposit your ETH or wrapped ETH on, for example, something called Frax Lent, and then get a yield of around 6% on S Frax. So that means that you're basically get 4% free yield on your capital. So I would recommend taking a look at Frax for a kind of a modest yield. I'm not really a degen. I mostly manage my portfolio. That's also my my background is managing for like funds before. So for degen yield, I would recommend maybe looking into Tricurve, which I personally like, would now give around 20%, or Llama, Llama, which is interesting on Curve. And of course, one of the other more degen plays is a leveraged ETH position on FX. FX is a new protocol which recently was added also to Convex. And there you can basically, I think, get around 30-40% base yield on ETH. But there's a couple of risks involved. So I would not highly recommend it. I recommend for new people, just take a look at Frax and SFrax and try to stay with the blue chip protocols and not stare yourself blind on 20, 30, or 100 or 200% yields, because most of the time that's a scam or not even real, I would say.
Well, thanks for sharing. There's certainly a lot of projects I have to check it out after this podcast then. Well, to keep building on that, we seem to mention a bit about impermanent loss earlier before. So next question I would like to ask Clement, let's go back to a little bit basics here, just so our listeners are on the same page with us. So for users who are considering doing like some farming or some staking on DeFi protocol, could you break it down, like the concept of liquidity pool for our viewers, like in a very easy to understand way?
Sure. So, liquidity pool basically is, for example, if, like for most simple cases, if let's say you want to provide liquidity into some of the LP pools, what you need to do is, most of the time you need to pair like a stable coin with the token that you want to. For example, if let's say you want to provide liquidity in Pancake, maybe what you need to do is to put in your Pancake tokens and then you put in USDT, and then what happens is that you get an LP token. So you can liken it to basically, if let's say you go to a farm, and then you tell the farm owner that you want to invest in his farm. So what you need to do is basically give him some grass and give him some tools, and then what he gives you in return is a piece of deed saying that, okay, you own this grass and some tools that you have contributed to the farm. And then from there, whatever the farm earns in returns, it gives you a portion of those. So yeah, basically that's what liquidity pool is.
Yeah, I loved your analogy. And I also wonder, like, for yourself, what sort of factors you would consider before entering a liquidity pool then?
I guess some of the factors would be things like whether is this protocol safe? Is it safe from being hacked? So I know that some of the DeFi users, what they do is they even go to the backend data, they go to the backend code and to see whether if the smart contracts or the codes are even safe at all. I'm not too much of a technical person, so I don't really know how to see it, but other than that, I think one other thing to take note of is impermanent loss. So basically, impermanent loss basically is if let's say you are going to provide liquidity into a pool that's extremely volatile. For example, if let's say you are gonna provide liquidity for like a Pepe burn where basically the token price is going to be extremely volatile. I think what you need to be wary of if let's say it's giving you high APY, but in retrospect, maybe because token prices is going down, the tokens that you get back might not be able to cover for the APY that you get. So yeah, basically that's some of the few things that users should look out for.
Great, thanks for sharing to a listener. Well, I would also like to ask the same question for Amadeo, because you have you're a crypto AG, very experienced in the DeFi world. So, what sort of factors would you consider before providing liquidity?
Yeah, that's a great question, right? Like, I think actually looking at traditional markets, let's if we go back to first principles, right? Like, if I buy a Tesla share or a whatever share, right? Do I then think, like I'm going to provide liquidity to this market, right? Not really, right? It's not really something you do because it's mostly something that sophisticated market makers do. So in the current financial market, you buy and sell shares and you give your money to a bank that you then save, and then the bank invests it in money market funds, and that a money market fund selects like which liquidity pools make sense to like invest in. It's beautiful and very good to see that in decentralized finance, we use something called automated market makers, and we basically democratize liquidity provisioning to everybody. And we also have a provable amount of certain like assets, right? Because in the traditional markets, you have no idea. You're going to buy a Tesla share on whatever brokerage platform. Like, am I sure that they don't just print those shares and say that I own Tesla, but I don't? Right? You're not. You cannot really know that, right? So that's a big match. So DeFi, in my opinion, should win the Nobel Prize for inventing openly and orderly markets, right? Because they we are building a system based on the rules of mathematics, not on the rules of man, right? So that's a very complicated introduction, but like I would say that it's a little bit weird actually that there are so many people providing like LP liquidity by themselves with zero understanding of these complex dynamics that go into that, right? At one hand, it's something I would say it's weird. At the other hand, it's a positive thing. So it's still an ongoing discussion, and I don't know what the best answer there is. I'm obviously a fan of open financial markets, so I think it should be open for everybody to provide liquidity. But I think what is dangerous, what we see in today's markets a lot, is very fancy websites like PancakeSwap or like other weird, like fancy, like almost casino looking websites where they kind of lure you in with certain incentives to provide your tokens as a liquidity thingy and earn yields, right? It kind of logically makes sense. Theoretically, it sounds like, yeah, you can make money with that. But the fact is that actually 80-90% of people that do liquidity provisioning, even sophisticated ones, are losing capital, right? And the only way that capital is being gained in LP pool is because there are certain incentives. So there was like a Pancake incentive for a while, but that's dried up. So most people on Pancake are losing money. Most people on Uniswap are losing money, right? So, and there's a lot of research being done right now. The one of the more efficient AMMs is Curve. You can, but that's more like with stablecoins. There you can potentially make a little bit of a yield, but not also that much. So unfortunately, liquidity provisioning doesn't really make that much sense for individuals, I would say. There should be overarching tools that educate people about where to provide liquidity, or there should be like automated market making firms that kind of take people's liquidity and then distribute it in better ways. And there's a lot of projects working on that right now, right? So when AMMs first came out, I also used it a lot because of the incentives. It looked like you're making a lot of money, and at the end of the day, you do make some money if you're lucky. But it's a little bit of a gamble, and most people don't really get that. And I think it's something that people should be more aware of. And it's also something that more projects should be aware of when they're building interfaces or projects, because most of the things lose money, and projects should be aware of that and try to focus on solving these issues, because there is a lot of projects working right now on solving these issues. You have Token Mac V2, for example, is coming out soon, which I think is a potential solution to that issue. There is a lot of ways to solve that. You could like, I'm doing DeFi stuff like almost every day, right? Like, so for me, like I think I'm mostly making money, but actually when I calculate all these things, sometimes I'm also losing money, right? So it's like, it's a sophisticated thing, and I think more sophisticated players or educated people should be doing that, and retail that just joins the space should be well aware that it's a very competitive and dangerous space, and that you probably mostly will lose money with it.
Yeah, I agree with you. At the end of the day, education is really the key when it comes to impermanent loss or DeFi, or not just DeFi, but a lot of areas. This is why we do this type of podcast and bring all the experts in the area to share the knowledge. And this is why I'm having such a good time talking to you guys as well. Well, moving on to, I kind of want to touch base on impermanent loss again. So, Shin, I wonder if you have any like solution to minimize impermanent loss. Like, what would you do personally?
There are a couple of ways to do that. But as the previous speaker noted, most people are on Uniswap, and the liquidity providers, they actually lose money, and one of the key ways for them losing money is due to impermanence loss, and that's very easy to understand because in the crypto world, the value of your assets fluctuates quite rapidly, and impermanence loss happens both ways. Which when the currency or the tokens that you have traded with or provided the liquidity has wildly fluctuated from the value that you have initially put in the LP, right? And that is sort of expected, as I said, because in crypto it's supposed to be volatile, right? The partial good news is that some of these impermanence loss are, it's just losses of opportunity, I would say that, right? Because you could have earned more, but you didn't. It doesn't mean you really made a loss, but it only meant that you could have earned more, right? So now,
well, not really true in my opinion. But
well,
yeah.
if you, for example, if you put in Bitcoin, right, Bitcoin and USDT, and then Bitcoin increased by 20%, right, you have impermanent loss because if you put all the money on Bitcoin, you have earned a lot more.
Well, it's a bit deeper, right? There's a lot of toxic order flow, right? Like the big problem is because the price of a asset is not set at a AMM, and that is the biggest problem. If the AMM would be smarter, or the Oracle, that's not a big, because you shouldn't use any oracles, like external oracles, in any DeFi system, right? But if the Oracle is smart enough to know that, hey, this is the current price, and I'm not going to sell it to you for lower or higher than that price, right? Or I'm going to wait a little bit to see, that's kind of a hard problem. But right now, the price is set on Binance, and then you get like trading bots that just arbitrage and destroy the AMM pools and just only give the toxic, so the bad order flow to those AMMs, and the good order flow to like the centralized exchange.
No, what you say is absolutely true. That's definitely one of the ways we lose money. But imagine a situation, but you're talking about more like a short-term period, right? Like, let's say if you put in the money in AMM, right? Bitcoin price is at 10,000 right now. You put in money, you put it there, you get the LP token. Maybe 1 month later, it's 20,000 Bitcoin right now, right? No arbitrage, no nothing happened, right? The price just moved to 20,000 Bitcoin. You take your money out. Did you lose any money? You only lost money because you could have earned more, because if you have put all the 20,000 onto Bitcoin,
well,
you have earned more,
in between,
right?
You lose money because of toxic order flow, right?
Sorry? Say that
like you lose money because of toxic order flow a little bit, right? Like,
well,
it's not
it's
luckily
a little bit, but then if your price of the asset has doubled, your main impermanent loss comes from loss of opportunity, right? That amount of money that you could have earned, but you didn't. I'm not saying that what you say is correct as well. Like, there is impermanent loss from what you mentioned, but there's also impermanent loss due to the lost opportunity, because you have another 10,000 in your liquidity that's parked as USDT, where you could have earned more if you place it at the Bitcoin, right? That's one way of us.
I think that's a wrong definition of impermanent loss. Like, you make impermanent loss because it's not only because, the price where you could say that. I think those definitions are not fully fleshed out yet, right? So there needs to be a lot more academic research into this. But like the problem is, because when Bitcoin fluctuates between that 10,000 and 20,000, there's like wicks in between, right? And those wicks in between are generated by market makers. The market maker can wick an AMM and make the price on the centralized exchange flat, and then just kind of suck out liquidity out of a AMM.
I again, like I said, I totally agree with your definition. One way of lose through this is the fluctuation of the point of the price. But if you can look it up, I'm pretty sure that if there's absolutely no spread at all, just by purely putting money in the liquidity pool, and the prices deviate from there, the amount of value that you would have lost is one of the ways that we define as impermanent loss as well. But I guess we can, we can argue all whole night, but I think, we can have different definitions. But it doesn't matter now, it's just terminology. If it's not called impermanent loss, but I'm happy to call it opportunity loss.
It's a big problem in the space. Like, we really need to solve that, because again, in my opinion, like, if we don't solve that problem in DeFi,
but we're talking about two different problems, right? Just different terminology. I think the problems that you mentioned, I totally agree that there is this problem. And I guess the other problem I was talking about is the opportunity loss by putting an LP token there, and the price has drifted very far away, and you have this opportunity. Like I said, I don't want to go into the terminology argument. Let's call it, opportunity lost. Right, lost opportunity, because if you're putting an LP token at $10,000, the price has now moved on to $20,000. If you take out your LP token is worth a lot less, right, because of that lost opportunity. And so
so if you talk about these two kind of losses, how we can actually mitigate it, I think the first one, you already made a very good point, right? There needs to be a better algorithm. There needs to be a better way in technology about market making, about how we set the oracle price. There remains to be a better way to actually improve that losses in that area. And I think in the portion where I mentioned where there's an opportunity loss, the way that a lot of people, the bots out there that try to mitigate these kind of losses is by doing some kind of short, right? If you short the asset so that if it goes one direction, it's protected against one direction, and that part of the opportunity loss is kind of protected. So that's one way to do it. The other way to do it is, but it's very risky. As one of the previous speakers has mentioned, it's kind of risky. People will take that LP token and put it onto the farm and try to get a farm yield out of that. And hopefully, whatever you get out of the farm yield would be more than whatever impermanence loss that you would have. But again, as I think every speaker here has mentioned, that we have to be careful. We have to do due diligence for that, because a lot of times the yield from the farm might not be sufficiently big to cover the impermanence loss, right? So there are a couple of ways to do it. One is through better design of the entire trading system, if you will. In my opinion, the other one is through hedging. And the third one is just to find other opportunities to use your LP token, either through yield farming, or put it on margin.
You mean on-chain hedging or off-chain hedging?
Sorry?
You mean on-chain hedging or off-chain hedging?
I think you can do it both, right? But I mean,
I don't think so.
What's it? You can do it off-chain hedging, but if you do it on-chain hedging, you will still if it's a reliable one. If once is very liquid and once non-liquid, you're fairly protected. The only problem is that if you do on-chain hedging and both of it is done on a very illiquid or a highly volatile blockchain, right? That would be a problem. It's not perfect. It's never going to be perfect, but it mitigates.
Yeah, and I think we should all be kind of aware of that. Like the current, like a lot of current AMMs have a lot of problems right now, and it's kind of interesting to see that with new change, everybody's just like, oh yeah, we're just gonna do everything the same thing again. If I think if we would design DeFi again today, we would not use like Uniswap V2. We would just like directly skip that and go more towards like a Curve or Maverick kind of model, I think. And then we would be aware of like, shit, we shouldn't let Binance lead the price, like the main price making. But yeah, there's nothing really you can do against that. Funny thing is that nobody really fully understands it. So it's a big invitation for anybody that wants to research this topic. There's a lot of papers and there's no final answer yet. So that's great. A lot of opportunities. If we solve this, we will make.
It's not going to be.
Then we can make it better.
I don't think it's going to ever be solved. It can be mitigated. It can be minimized. But I think as long as there's going to be, I think it's going to take many, many years to solve it, right? We can minimize that. We got the big players like Binance, who's going to be there for some long time. You could decide to detach yourself from Binance, but at your own risk. But like you said, unless you can.
Well, there's Swap. There's like Swap that just stops, right? So it's Swap. What Swap does, like it's an AMM. They're still really small.
Exactly, they're still quite small.
But what they do, they just stop trading. So they just like look at the price and they just stop the AMM. And it's like a little bit centralized, but they just stop trading. They just stop trading if the AMM price is wrong. They just don't take any trades and then wait until the price gets better and take trades.
But that basically means you can't trade all the time, right? So there's always a catch. There's always a catch.
There's always a catch. Yeah. Yeah.
Oh, by the way, you guys mentioned Uniswap. So I wonder, because they are considering adding a KYC feature. Like I don't know what that platform is doing, and then at the same
Ridiculous.
time they're trying to take away 0.15% transaction fee directly goes to the team. So I wonder, Amadeo, like, what is your take on that for Uniswap?
Yeah, I have quite a strong take on that, and I think that I mean, I'm not really a big Uniswap user anyway. I more use Curve or other AMMs, right? I think they're shooting themselves in the foot heavily. They still have like first mover advantage, so people will probably still use it. But I do hope we are educated enough to now try to not use Uniswap. I actually would like to recommend anybody on the call to check out, DeFi Llama, and then you have Llama Swap, and Llama Swap always gives you the best AMM vetted to use. So it will always pick either Curve or any of the ParaSwap or 1inch or any of the aggregators. There's also a difference between 1inch and ParaSwap and Curve. Like it's kind of interesting. So I would really recommend everybody to go to DeFi Llama and then check out Llama Swap and use that. And that's actually just stop using Uniswap. Just don't use it anymore, because like one is that they mostly don't have the best. Well, they have good prices sometimes, so sometimes you should use them. But most of the times they don't really have the best prices, so it's better to use aggregators. So I think they're shooting themselves in the foot. They're letting go of a core culture to DeFi, and I think us as an industry, it's important to very firmly stand against that and say, yeah, that's not DeFi. That's whatever that is, right? And it's only the front end though, so the contracts probably will just keep on working. But I think they shoot themselves heavily in the foot. And let's see what happens. I'm not sure. I think it's a very negative thing for the overall space, and it's very sad to see that they did that. Yeah.
Yeah, I'm completely on the same page with you. Seriously, I don't know what Uniswap is doing these days. Well, the last question I have for Clement. Seems you are in like travel or crypto exchange as well. So I wonder which sector of crypto you most bullish on and most optimistic about, because there's so many sectors, right? Whether it's DeFi or RWAs or NFTs. So what's the sector you most bullish on?
Thanks for the question. I think listening to the debate from both speakers, pretty insightful. So I guess for me, when it comes to narratives, it's always been about trends. I mean, we've seen the metaverse trend, we've seen NFT trend, we've seen meme coins pumping and dumping, and so on. So I think in recent times, there is a RWA talk, and then a couple of months ago, there's liquid staking, and I also hear in more recent times, I think things like ZK is still not fully developed yet. So for me, infrastructure is where I want to be at right now, because I think there is going to be a lot of players coming out to do what they want to do. For example, I think Base has been something that is pretty popular in the past couple of months as well. So let's see who's going to be the most used infrastructure coming into the bull run. Maybe in who knows when it's going to be. But for me, definitely infrastructure, because I think once someone widely uses something, and there's so much volume going into there, I think that's where we are going to see huge traction, more dApps building onto it, and so on. So yeah, let's see where it goes.
Yeah, great. I love it. And that sums up our episode today. Well, I feel like I know so much better about DeFi already, especially from this heated debate. And there are definitely some really good tips on which APR, which farm, which liquidity pool to choose. And if you are a DeFi degen, you should definitely check out some of the DEXs or some of the projects that our guests mentioned today. Make sure to follow our speakers on Twitter, and also make sure to follow MarginX. We'll be hosting here regularly, so stay tuned to know when our next Twitter space will be. I hope to see you guys again, and thank you everyone for attending this discussion, and we will talk soon next time.
Hey, thanks everyone. Thanks.
Thanks, guys.
Bye.
Thank you. It was amazing. Thank you, guys. Bye-bye.
Bye.